All right, let's look at partnership. Taxation of partnership. Taxation of partnership. Okay, so what we'll be looking at under this chapter is what is partnership. Okay, you know, we have partnership law. Okay, we have partnership law, we have accounting for partnership, and we have taxation of partnership. So the law at foundation level, they'll test it under business law or corporate law. Then the accounting part at foundation level, they'll test it under FA, partnership. Then for the taxation part, they'll test it in skills, which is what you are doing now. So you look at the definition of partnership, look at the partnership agreement and registration of same with relevant tax authority. You look at relevant tax authority, there's ROTA. You look at allowable and non-allowable expenses, similar to what we have done under, taxation of small businesses, sole proprietorship. Then computation of the income of a partnership business, then taxable income of partners, then partnership loss, tax treatment under change in partnership, then chapter review. So quickly, what is partnership? It's rare. ICAN will not ask what partnership is. The ICAN will not ask what partnership is at this level. But partnership is governed by Partnership Act of 1890 and is defined as a relationship that exists or subsists between or among persons carrying on business in common with a view of what? Profit making. So where two or more persons come together to carry on business, we say it is what? It is partnership. So at least there's a minimum requirement for partnership. So partnership is an association of two or more persons who come together with a view of making profits. A partnership has a minimum of 2 and a maximum of 20 members. I hope you're aware of that. Minimum of 2, maximum of about 20 members. But when it comes to, let's say, however, Section 92, subsection 2, subsection B of CAMA allows partnership of more than 20 persons to be formed in Nigeria, provided it is for the purpose of carrying on practice of legal practitioner, chartered accountant, etc. So the law says that, the rule says that 2 to 20. But when it is partnership for professional purposes, like legal firms, chartered accounting firms, it can go above 20. It can span into 50, as the case may be. All right, so that makes sense. Audit firm is accounting firm. Accounting firm. So let's move further. The people that forms a partnership are known as partners. It is the business that will call partnership. You understand what I mean? Okay, let's look at partnership agreement and registration of same with the relevant authority. Now, there are laws that guide partnership. Specifically, the Partnership Act guides partnership. But however, there's a flexibility. The flexibility is that if two or more persons are coming together to do business, let us give them an avenue where they agree to what how they want the business to be run. Do you understand? So it therefore means that the both persons or the 5 persons or the 10 partners can come together and write what we call a partnership deed. So a partnership deed is more or less like an agreement that is created by partners to guide their affairs. Now, the partnership deed sometimes may have some lacuna. Lacunas mean there may be some places that the partnership deed did not cover. So where the partnership deed fails to cover some areas, then the primary document to fall back to is your Partnership Act of 1890. I don't know if you understand. So, for example, the partnership did not mention anything regarding to profit sharing. It therefore means that profit is going to be shared equally, according to the Partnership Act of 1890. That's what it states. So, where the partnership deed fails to address some certain issues, the partners may refer towards the Partnership Act of 1890 to carry on the business. Do you understand? All right. So, the conduct of a partnership business will usually be in accordance with certain terms and conditions as agreed by all the partners. Now, a partnership agreement or deed, they call it partnership agreement, partnership deed, or what called articles of partnership. It's the same thing, anyhow they put it. Would spell out the rights, the duties, and interests of the partners in the business. Then I said the following are some of the matters usually dealt with in a partnership agreement. So what are those things that the partnership agreement will contain? Number 1, it will contain what the amount to be contributed by each partner as capital. Note that in a partnership business, not everybody contributes capital. Some people contribute capital, some people contribute skill. You understand? Skill. So it's usually a combination of both capital and skill. So where capital is involved, the partnership agreement will state how much each partner has contributed. Then the next one is that it also state the interest payable, if any, on capital. That capital that you contributed to the partnership is as though you loaned the partnership, as though you loaned the business. Therefore, you'll be paid interest on that capital if it is agreed upon. You get? Then next one is salary, if any, payable to a partner. You know, we have different types of partners. We have dormant, active partners. We have the partner that you only use their name. I forgot the name of that person. So, but for the active partner, this one usually comes to the business. In fact, it manages the business day-to-day activities. So it will be right for you to pay that guy salary because he comes to the business every day. It is different from the other partner that may not come to the business for months, even for a year. So therefore, where salaries are agreed is going to be stipulated in the partnership deed. You understand? And the next one is the rate of interest payable on loan provided by any partner to the partnership. Where capital is insufficient to run the business, so partners may want to give loan to the business. So when they give loan, the partnership should state, oh, are you collecting 2% or 3% interest on that loan? It should be stated in the partnership deed. Then the profit sharing ratio as well. You know that one, how they will share profits and how they will share loss. They don't just share profit. If there's loss, they will share loss too. Okay. So a loss will look like a reduction in the capital that they have contributed. That's how a loss will look like. Then the rate of interest on drawings made by the partners. A partner may need money, but he may not be able to wait till the end of the year when they are going to do share of profit. What is going to happen is that he can draw. You know, drawings now, when you collect money from your business. So when he draws, they usually attach interest to it. The reason why they usually attach interest to that money that you are drawing is to restrict partners from drawing. You understand? You know, if there's no interest, anybody can just come one day and say, oh, I want to collect 100K, I want to collect 1 million, I want to collect 2 million. But if we say that for every money that you take out from the business, you pay 20% interest, to go and collect that money will be difficult for you. So that is what it entails. So these are the things that are usually contained in a partnership deed. However, where no fixed terms are agreed upon by the partners of the partnership agreement. Okay, let's go. However, where no fixed terms are agreed upon by the partners or the partnership agreement is not in written, then the content of the partnership deed of the Partnership Act of 1890 would guide the conduct of the partners in the partnership business. And they include, it's what I've said, Abby. So where there is no deed, where there was no agreement between individual partners, or where the partnership was not in agreement, where it was not in written, they did not put the agreement in written, then that law that the government have set for partnership will guide the partnership business. That law is from England, though. Yes, they brought it from England. Part of the laws that were brought from England. Yes, 1890. Not the time, 1890. Which Nigeria do that one? So it's 1890. Even when Nigeria got independence. So you are still of 1890. So it's basically from England. Although there have been some little changes, but very minute. Very minute, but it's from England. All right, so what did the partnership deed say? The partnership deed says that what each partner is to contribute the same amount of capital. So if there's no agreement, if there's no partnership agreement between partners, the Partnership Act of 1890 is saying that everybody must contribute the same capital. The next one is that no partner is entitled to interest on capital. So if you bring capital, we are not going to give you interest. I guess that is what the law states on a normal day. Then no partner shall be entitled to salary. We're not going to pay you salary. Okay, we're not going to pay you salary. All those ones that they say we will pay salary, we will pay interest is basically mutual agreement. It's not like it's compulsory. Then profit and losses are to be shared equally, irrespective of the capital contributed. In as much as people do not say to your mouth that look, oh, this guy is going to be, oh, this guy is going to be, oh, then profit and losses are going to be shared what? Equally. You understand? All right. Then last one say a partner who advances the partnership shall be entitled to an interest of 5% per annum on such advance. If he gives loan to the business, he's going to be entitled to 5% on that loan that is given to the business. You get? Okay, so let's see, what do we have again? The Personal Income Tax Act cap LF31 and FAS, it requires the partnership, employee, or agent to charge, in charge of the principal office or place of business of a partnership in Nigeria, shall without notice or demand thereof register or cause to be registered with the relevant authority. Certified copy of the partnership deed where no event or deed is in existence, particulars of any written or oral agreement under which the partnership is currently established, and where such particulars have been so registered, notice of any subsequent change therein agreed upon, agreed between the partners shall be similarly registered with tax authority within 30 days of the agreement. In simple terms, what they're just trying to say here is that the same way that you register your business with tax authority, this is your business that you open now, business, company that you register with tax authority, it's the same way that you're also going to register your partnership, I get it now, with the relevant tax authority. Please note, we don't tax partnership in Nigeria, yes. We don't tax partnership in Nigeria. So that is why you see the word, the personal income tax. So we are taxing the partners, not the partnership. I guess now. So we are taxing the individual partners, not the partnership. So what we are trying to do is a very simple account. What we are trying to do in this account or in this tax here is that we are going to calculate the money that comes to the hand of each partner. Simply means that we are going to calculate the total income of the partnership. Abi? So if we know the total income of the partnership and deduct some relevant expenditure, what is left will now be shared to all partners. So it is when we have shared it, the money that enter my hand, they will tax it. The money that enter your hand, government will tax it. The money that enter another person, and government will tax it. That's the way it operates. You know, for company, government will tax the company direct. You understand? Then for sole proprietorship, so government will tax the what? The sole proprietorship, the sole proprietor, the owner of the business direct. All right. So let's go. Where the particulars of any partnership have been registered under the provisions of Section 8, subsection 8 of the Act, the computation of the gains or loss, the computation of the gains or profits of a partner therein may be made by the relevant tax authority on the basis of those particulars as they apply to any relevant time, and in the event of failure of the partnership to comply with any demand made under the foregoing section, notwithstanding the provision of the section. Basically, what they are trying to say is that during the registration of the partnership with the relevant tax authority, they are registering each individual. I get it now under personal income tax act with the relevant tax authority. So at any time, the RTA, which is the relevant tax authority, they are already aware that, oh, this partnership is owned by 20 persons. Oh, this one is owned by what? 15 persons. And each of these 15 persons must be what? Must be taxed. So if there's a change in partnership, okay, if there's a change in the people that owns the business, you have to also notify the RTA of the changes. So they will not think that that person that have left the partnership is still there collecting money. You understand? That's how it works. Relevant tax authority. So who is the relevant tax authority? The relevant tax authority in relation to a partnership for a year of assessment is the tax authority of the territory in which the principal office or place of business of the partnership in Nigeria is situated on the first day of that year or is first established during that year. You know, when businesses have branches, okay, when businesses have branches, what the law knows, okay, the laws like CAMA, you know, laws like personal income tax, what do you call it, company income tax, all those taxes, the law, what the law recognizes basically is their head office. So you can have 50 branches as the case may be. GTB can have all the branches in your own state. What the law recognizes basically is their head office. Marina, Abi. So that's what they recognize. So it is the head office that consigns tax authority. Are you getting it now? Not the branches. So what we're trying to say is that the way we have now here, if I want to pay tax, you understand? I've told you before, I will pay tax to the tax office that is closer to your business. I've told you before. So for businesses that have branches, if they want to pay tax, they will pay tax to the tax office that is closer to their head office. I don't know if you get what I'm trying to say now. Not who send branch. Head office. Because who is paying the tax? It's the head office that is paying the tax. Because you know what we do is that for the fact that GT Bank has branches all over Nigeria, they only be paying one account. Do you understand? It's not like they're preparing account for year. No, definitely every branch will have their operations, Abi, and their account. But for the purpose of audit, I get me, and tax compliance, it's just one account. If they're taxing GTB, they're only just taxing GTB once. We will not tax the one in Ogba. You know, in Ogba, you can have like 3 or 5. We will not go and be taxing individuals. So we are taxing GDP once as one. So therefore, the tax authority or the ROTA, relevant tax authority, the tax authority that is resident, that is available, as at the head office of here, the of GT Bank. You get that's what I'm trying to tell you here. Okay. All right. Then let's look at the allowable and non-allowable expenses. You know, it's a business. Partnership is a business. I mean, for the purpose of making profit. One question that I usually ask is that they'll tell you to distinguish between partnership and joint venture. Understand? Partnership and joint venture. You can check that up. It's in your accounting textbook too. Your accounting textbook. It's not a big deal. But for allowable and non-allowable expenses, you know, as a business, the tax authority will not just say any expenses that you incur, take it out from your account. If the tax authority allows it that any expenses that you incur, take it out from your account, trust me, the shareholders and everybody will be incurring expenses from the company. Does it make sense? You understand, Abi? Everybody will be incurring expenses from the company. And if every expense is being incurred against the profit of the business, what will happen? Profit of the business will drop. Therefore, there will not be enough tax to be gotten by the government for that year. So what is going to happen? The tax authority now says, okay, for fairness, we are going to list expenses that we can allow you to include in your profit and loss account. That is what they call what? Allowable expenses. And we are also going to list some expenses that even if you incur them, you cannot include them in your P&L account for the purpose of taxation. Those are what we call what? Disallowable expenses. You understand? So allowable and disallowable expenses to a partnership business, they are the same as that dealt with under chapter 16. Please refer to chapter 16 for allowable and disallowable what? Expenses. I don't know what is in chapter 16, but let's check. But that should be accounting and taxation of sole proprietorship or company. Let's see any of them. Let's just check. Should be for company, Abi. Sole trader, okay, yeah. So the reason why I will go with sole trader is because I told you that partnership is not taxed, Abi. It's the partner that is taxed. Okay? So it's the same thing. The allowable and disallowable for sole trader is the same thing with the allowable and disallowable for a partnership. So those times that we have been discussing that, if you pay, yes, all those donations, exactly, to non-recognized organization, all those expenditure that you incur for personal use, family and friends, all those capital expenditure that you incur in your business, all those ones are disallowed. I guess now it's the same thing. They are disallowed. They are disallowed. So it's not big deal. We'll just borrow that knowledge and bring it back here. So let's go to where we are. Okay. So that is that. Now let's look at the computation of income of a partnership business. Computation of income of a partnership business. How do we compute the income of a partnership business? Now, the computation of the income of a partnership is similar to that of a sole trader. You understand? Similar to that of a sole trader. You know, sole trader is like a one-man business. So if they want to tax, if government wants to tax a one-man business, government will say, they call it self-assessment. If you hear that word self-assessment, it simply means that government is telling you that declare your income and your expenses by yourself and pay your tax by yourself, no issues. But when you are doing this, be truthful. Don't lie, have integrity. So that is why companies are allowed to prepare their accounts for themselves and then, file their accounts by themselves. So it's not like it's tax authority that will come to your company and say, bring your books, let me complete that for you. No. The company, if the chartered accountant can do, let him do it. If he cannot do it, let him give it to a tax consultant to do it for him. So it is self-assessment. Government is trying to say, I trust you as a good citizen, that you'll be able to capture your revenue and your expenditure and file. We call it self-assessment. You understand? So the same thing is going to be happening here. When we are computing the income of the partnership, we are going to calculate all the income that the partnership received during the year and deduct all the expenses as far as they are allowable. Then what is left will not be what we share. We are not taxing what is left, though, don't forget. It's what we will share to the partners. Yes. So we will not tax the partners using personal income tax. I guess it now. The same way we tax individuals like salary earners. It's the same way we are taxing who? Partners. And the same way we are taxing sole proprietors. Most proprietors, they are not taxing them based on 30%, 20%, all those their company do. We are taxing them based on what? That tax table. The first 500,000, that first 300,000. Yes, that tax liability table that we usually do. First 300, next 300, 500, 500, and the likes. That's how it works. So let's go. So the computation of the income of a partnership is similar to that of a sole trader, save that salaries, that the word save here means except. Okay, except that salaries, interest on capital payable to partners, and cost of passage to and fro Nigeria, wholly or mainly undertaken or for the purpose of leave or recreation, are allowable expenses in computing the partnership income. Unlike the case of individual or sole trader, it is pertinent to add that private or domestic expenses of a partner are not what? Allowable in ascertaining the computed income of a partnership. One basic thing that fails students under this, I'm going to tell you for free. When ICAN gives you a question, okay, when ICAN gives you a question, they are going to include things like interest on capital. I mean, when I told you before, once the partner gives the partnership money, that capital, they'll pay them interest. Interest on loan. I mean, salaries. You can be paying some active partner salaries. ICAN will include all those things in the question. Now, where student fails is that when they are computing the profit of the partnership, they used to go and include those things in their solution. Those things are transactions of partners, not transaction of the partnership. I don't know whether you're trying to get what I'm trying to say. Yes, all those things that you pay to partners. No, they don't pay dividends. Yeah, they don't pay. It's just share of profits. It's like company that pays dividend. So all those transactions with partners should be excluded when you are determining the profit of the partnership. I don't know whether I'm making sense. So when you are computing the profit of the partnership, include business expenses and business income. But income that is going to partner, like interest on capital or interest on capital and interest on loan, it's like an income to a partner. You don't need to include it when you are computing the profit of the partnership. You will only include those things when you are trying to compute the tax liability of the partner. I don't know whether I'm making sense. So at this particular level, one important point that you must take home is that when you are preparing an account for partnership, or when you are calculating the tax of a partner, I get it now, transactions that relate to the business should be separated from transactions that relate to who? The partners. You understand? Very, very much important. All right, so let's look at taxable income of partners. Taxable income. Now, the income of a partner from a partnership in Nigeria shall be deemed to be derived from the territory of the relevant tax authority in relation to the partnership. Okay. Now, income taxable in the hand of a partner include, what are those income that we tax when they're in the hand of a partner? Any remuneration like salary, you see it now, interest on capital, or cost of passage through and fro Nigeria, wholly or what? Mainly undertaken for the purpose of leave or recreation, which is charged in the partnership account in respect of that what? Partner. That passage that you're talking about is like travels. You get, that's what they call passage, cost of passage. Now, is share in the income of the partnership computed in accordance with what the provisions of this act after the deduction of any charges to which the paragraph above applies. So what I tend to talk about is what? When I say is share of his income, that is share of profits, is also taxable. I get it now. So these are the income that are taxable in the hand of the partnership. The salary that they pay you, once the money comes to you as a partner, will tax it. The interest on capital is an income, Abi, will tax it. Because like a money coming to you, will tax it. Then after the end of the period that you now collect profits, Abi, share of profits, also an income to you, we're also going to tax it. Those are the income that are chargeable to tax. Then cost of passage, we gave you money, I get like travel allowance, like an income, we'll tax it as well. Let's look at partnership loss before we take it. And that's all. This is where we are stopping. So let's look at partnership loss. Where upon the computation of the accessible gain or profit of partners from the partnership, there results a loss. The loss shall be shared among the partners in accordance with the partnership agreement and thereafter set up against other income of the world partners, that is current year loss relief. Any unrelieved loss shall be carried forward and set off against future profit of the partners, that is carried forward loss relief. So you see that loss relief applies here too. So what we're trying to say here is that if after preparing the account, we realize that there's a loss. We are going to share that loss using our ratio, our profit and loss sharing ratio. I get it now. And we can also carry losses forward to the next year to set it up against what? Profit for the next year. It makes sense. Okay, so let's look at tax treatment under change in partnership. A change in the composition of a partnership business shall include the following. One, admission of a partner. Admission of a partner simply means that we were formerly 3. We now bring in 1 more person. It therefore means that the partnership deed that we did before has expired. Yes, because the composition of the partnership has changed from 3 to 4. So we are drafting a new agreement for the 4 of us. Where a new partner is admitted into partnership, he is deemed to have commenced a new business. We're going to be using the commencement rule if we're admitting a new partner. Hence, the application of the commencement rule will be applied. However, where a partner resigns from another partnership business in the same or similar trade before forming or joining a new one, he is deemed to be in continuous business. Hence, there will be no application of the commencement rule. In other words, it will be assessed on a preceding year basis. You get what I'm trying to say now? So if we are admitting a new person, that person that we're admitting as a new partner is going to be applying the commencement rule. I get it now, to treat or account for his what? For his income and expenses. But please note, if the person is leaving another partnership and coming to a new partnership, are you getting it now? In the same business, we are going to be applying the preceding year basis. Yes, not commencement rule. It's still in the business. I get it now. Still in the business. That's why they said, look at what they said there. Where a partner resigns from another partnership business in the same or similar trade, the same business, trade, before forming or joining a new one, is deemed to be in continuous business. Hence, there will be no application of the commencement rule. In other words, it will be assessed on a preceding year basis. The next one is retirement. Where an existing partner retires or resigns or dies, he is deemed to have ceased business. Hence, the application of what? The cessation rule will be applied. Okay, so when we are accounting for that partner's transactions, okay, that partner's profits or share of profits, we're going to be using the cessation rule. Where, however, a partner retires or resigns from a partnership in the same or similar trade or join another one, the cessation rule shall not be applicable. In other words, it will be assessed on what? On a preceding year basis. You understand that, Abby? It leaves this one to go and join another partnership, but it's the same trade. So the same thing, preceding year basis. Then the next one is amalgamation of partnership. Let's look at amalgamation of partnership. You know the meaning of amalgamation of partnership? 2 partnerships coming together. In a situation of amalgamation of 2 or more partnerships, there would be no application of the commencement or cessation rule. The qualifying capital expenditure transferred to a new partnership is deemed to have been transferred at its tax written down value. Hence, there will be no computation of balancing adjustment. Only annual allowance is claimable. So where 2 partnerships are coming together, you will not apply commencement or cessation. Let me explain. You know, when 2 partnerships are coming together, they will close their original partnership and form a new one. So somebody may be thinking that, oh, as you are closing that one, we are going to do what? Cessation. As you are forming a new one, we're going to do what? Commencement. But they are saying no. Am I making sense now? So you are not doing that. Okay? That's what they said there. There will be no application of the commencement or cessation rule. So what is going to happen is that asset that you guys combined from the individual partnership to form a new one, am I making sense now? You will just be charging your capital allowance on those assets going forward. There's nothing like balancing adjustment. No balancing allowance. Whenever you sell an asset, you get your balancing allowance or balancing charge, whether you make profit or loss on the asset. So you're not doing all those ones. You just continually charge your what? Depreciation or your capital allowance on the assets going forward. I get it now because you are forming a new partnership. Then the last part I'm going to be looking at is conversion of a partnership to a limited liability company. Sure, you know it's possible. You can convert a partnership to a company. Now, cessation rules apply in a situation in which a partnership is converted into what? A limited liability company, as the whole partnership is deemed to have what? Ceased business. Do you understand that? So, you know, you are changing the partnership to a company. In FA, will show you, if you had done FA, they would have shown you, you did FA, they would have shown you how to convert a partnership to a limited company, the accounting rules for it. It's not ratio. You will change the partnership company to a limited liability company. You change your account, yes. Anyway, they may not teach you because it's not a common question. That's how it is. But there are rules for it. It's a very interesting, partnership is a very, very broad and interesting topic. The accounting aspect, very interesting. Okay, so it's converted into a limited liability. So when you are converting a partnership to a company, so it's simply that the partnership has stopped. Abi? So since the partnership has stopped, what is going to happen? You're going to apply cessation rule to close the partnership. Okay? Now, in the same vein, the commencement rule applies to the new company. So since you are now forming a new company, what's going to happen? You will now apply commencement rule for the new company. All the qualifying capital expenditure like assets, items transferred are deemed transferred at their agreed values, and there would be computation for balancing what adjustment. So you will need to calculate for balancing adjustment because you are doing cessation. So since you are ceasing business, you are more or less like you are selling your assets to the new company. So since you are selling the asset to the new company, you're going to calculate whether there was a profit on the sale or whether there was a loss on the sale. But if it was amalgamation, there would have been no need for that. However, in computing capital allowance on the assets transferred, initial allowance is not allowed, and the capital allowance claimable would take into account the duration of time the asset has been with the previous owners. Okay, so that's as simple. So that is as simple as it is. So that is the end. That is the end. Okay, so we will not calculate initial allowance any longer. We'll just go ahead, but we are still going to calculate based on the number of years that we have also used the asset when we are under partnership. There's the remaining years of the asset that we're going to start using going forward. So that is all. That is all. The only thing that is left for us to do is just to take questions. How to tax a partner. You have to tax a partnership. Just take questions on that. So let's take a question. Let's take this this question. Erewa, Shola, and Wale. So first and foremost, we'll look at the requirements of the question, Abi. So we said that you are required to ascertain, you have 3 requirements, which is a standard ICAN question. He said, A, to ascertain the computed income of the partnership for tax purpose. It means calculate the income of the partnership of the business for the purpose of tax. You understand? You are not calculating tax, so just the income. Then I said the chargeable income of each partner for tax purpose. When you hear the word chargeable, in the hands of the partners, I guess it now. You know, when you make income as a business, I told you that you're going to share it to the partners. So in the hands of the partner, it becomes chargeable income. Then I said the tax payable by each of the partners. They did not say tax payable by the partnership. It said tax payable by each of the partners. You are calculating the tax payable by each of the partners to the partnership. So it's very simple. Now, in this case, what they did is that they said Erewa, Shola, and Wale have been in partnership as medical practitioners for about 7 years. The operational results of the partnership for the year ended June 30, 2024 has revealed what? The following. They had gross profit, right? And these are all their expenditures. Do you understand? They look at, they said interest on capital account. So what that means, Abi? And look at this part, interest on loan by Arewa. It means this. So, are we there? Okay. So now look at what is happening here. Look at this interest on loan by Arewa. Interest on loan by Arewa. So Arewa gave them loan and it's receiving what? Interest. I mean, the interest on capital accounts. So these are the interest that they're collecting for giving their capital to the partnership. Do you understand? So this is the net profit of the business. So we are going to start with this net profits. On a normal day, we are supposed to say, let us share the net profits to each of the partners. But the case will not be like that because there are some expenditures that we have here that are disallowed. You understand, that are disallowed. And how do we know First one is that we know that this depreciation is disallowed. Even if we are not sure about any other thing, we know that depreciation is disallowed. You know, depreciation is going to be replaced with what? With capital allowance. Don't forget. But with this other information that we have here, it will give us an insight on what to do. So look at what they are trying to say here. Other relevant information is as follows. They said office expenses include a donation of 800,000 naira to an old people's home. So you donated. So if we come up, we'll see office expenses. Let's check. Look at it. So inside here, there's 800,000 naira inside, which you donated to old people's home. That one not concern government. We're going to disallow it, Abi, by adding it back, Abi, because it has already been subtracted. We're adding it back. The next person said capital allowance agreed with the revenue was how much? 9.5 million. So capital allowance will be there. Capital allowance will be there to replace your depreciation. So we're going to add our depreciation back because you know we've deducted it before. Then we'll now deduct capital allowance. Then I said only Erewa is married with 2 children below 16 years of age. Then this one on a normal day does not concern me. You know, I've told you before, CRA will cover for it, consider relief allowance. Then partners' profit sharing ratio is Erewa 5, Shola 7, and Wole what? 8. I get just like saying 5:7:8. That's their profit sharing ratio. So that is all. So now let's prepare. The first one is what? A. What's the first thing there? Computation, Abi, of partnership income, Abi, of income of partnership. Accounting is simple. So what do? We are starting with this net profit, Abi. So bring the net profit. That is the profit I want to adjust. More or less like saying adjusted profits. So we have net profit. Egone, 9,425,000. You get? Good. So now we are going to adjust this profit to the available information that we have the same way. So let's be tracing it here. The same thing we are doing here too. Let's make it 2 naira. So let us add back our disallowable words, expenses. Abi? We added them back because they were initially subtracted. Disallowable. Are we good? So let's start with the first one, office expenses. How much are we disallowing? 800. Thank you, Jerry. Next one is, let's look capital allowance. We'll do capital allowance like down. You get. What again are we disallowing? Balance sheet. Where is balance sheet? This is the question now. No, we have depreciation. You know, we're going to add back depreciation. You get 7.8. So let's tick them as we are doing them here too. So we have this and this. So let's go. So salaries and wages is normal. Yeah, I'm coming. Salaries and wages is normal. It should be allowed, except when you are not paying it to your family members without them working for you. It's disallowed. Transport and traveling is normal. Okay. Insurance is normally allowed. Rent and rate is normally allowed. Office expenses is allowed. Only that in this case, they only told us that 800 was for donation to a body that we don't know. Then the next one is professional fees is allowed. Maybe audit fee, consultancy fee, they're allowed. Allowance for doubtful debts. Why are we disallowing it? Because they don't put specific. Okay, so specific, bad debt specific is allowed. General is disallowed. I get it now. So allowance for doubtful debts, it never even go bad. It's still doubtful. I get it now. So disallow it. They go on 650, Abby. 650. So let's take it out from here. Then the research has been done. Okay, we have staff loan here. Now, staff loan written off. It is not government fault that you gave your staff loan and you not collect it back. So we are going to disallow it. You understand? It's not our fault. So staff loan written off. How much, please? 270. So let's take it out from here. Now, if you notice, we are done, Abi. Staff loan has been done. Depreciation has been done. Now, interest on loan by Erewa and then interest on capital accounts. They're allowed. As a business, the business is the one making that payment. So it's allowed. You know, remember I was telling you that all those transactions with partners, you will still go and take them. Yes, you still go, we'll still go and treat them when we are now calculating the tax of the partner. You understand? So that it is allowed because the partnership was the one paying this set of people. I get it now. Good. Now let me add this, guys. You should be getting this answer. Let me add this, guys. Everything you have it. 9,520,000. Let me take it out. Let me add up. Sorry. You know you're adding. Help me add up. 9,520,000, correct. That will be our adjusted profits. Adjusted income, sorry. We've not got into profit yet. 18,945,000, correct. Now, don't forget that there was one thing that we have not yet picked. Depreciation. Okay? We usually show depreciation like almost last. You get, we will not include it there. If you include it here, you still get the same answer. But you know, presentation matters. So what we're going to do is that since we have added back depreciation, what we're going to do is to replace it with what? Capital allowance. That's what I say we're going to be treating last year. What's the capital allowance in the question? Agreed was how much? 9.5 million. You see it, the additional information. Yes, under II. Let me deduct. You should be getting 9.4. Just check, sure. Correct. So we are on point. So that will now be our divisible profits. You know why they call it divisible? Yeah? Yes, it's going to be shared among the partners. So they also call it computed income. So it's fine, Abby. So the B part, this is A. Now let's do the B part. Let's do the B part. Now, what's the B part saying? The B part is technically saying how to calculate the chargeable income. Abi? It simply means that the income in the hands of the partners. Abi? Chargeable income. The income in the hands of the partners. Are we good? So we have just, who are the partners? There are three partners, Abi. We have Erewa, Abi. We have Shola, and we have Wally. The show total, no need. Okay, so what are the incomes in the hand of the partner? Any money that comes to the partners, I get it, is an income. So all these interest, this one I see interest on capital account and interest on loan. It was an expense to the partnership, but an income to the partner. You understand? It's an income to the partner. Okay, so let's go on. So interest on, okay, they broke it down into end and on end. That's not an issue. So we can do ours like that as well. Any income from trade, profession, or business is an end income. We know that already. Why on end income is any other income that is not from trade, business, or profession. So capital, the interest on the capital is an end income. Please, how much is it? 225, 315, 360. All right, makes sense, Abby. So 225, 315, 360. Then this profit that was made, we're going to share the profit. It's an end income. The money was coming out from the business, Abby. This profit of 9,445. So it's share of profits, an end income. Share of profits. So how do we share? You know, the ratio is 5:7:8. So I share using 5:7:8. So help me add up everything. What do you have? 578. Yes. Yeah? 20. Are you sure? 20. So what you're going to do for me is that for Erewa, you say 5 divided by 20 times 9,554. What do you get? 5/20 times 9.44. What do you get? You get 2,361,000. Correct. So 2,361,250. Okay, do the same thing for the next guy. 7/8, 7/20 times the income. That's your divisible profit. Let's confirm that. 3 million. Okay. 3,305,000. 750. Okay, finally do 8/20. 3,778,000. So let's confirm that. 3,778,000. So correct. So all figures are correct. Okay, just figure me. Figure me before we do our on-end income. What do you get here? For Wale, okay. 4,138,000. That's correct. For Shola, 3,620,000. 700. I'm still 750. Can't be 700. It's 5. That's why I like, cross-checking. Yes, 750. So let's do for everyone. $2 million 586, 250. All right. So the only on-end income we have here is interest on loan. Did they give us the figure direct? Yes. Let's check. There's only one guy that even gave us loans. Erewa, Abi. So that will be 455. It's an income to him. He gave us loan and we are paying him interest. Yes, nice income now. So help me add up this guy. This one will remain the same. Okay. 3 million 41 041 250. So all figures correct. So these are total income. So you now understand what I was trying to say, Abby, that any transaction with the partner, I guess it now, will be treated as an expenses or income in your partnership account. But when you are treating your chargeable income, you are still going to bring them here because it's a transaction with the partner. You get. All right, so let's deduct. So, this is our total income. We are supposed to tax it. Abi, I'm supposed to tax the total income now in the hands of the partner. But I've told you, for personal income tax purpose, what is going to happen? We'll give them relief. Government will say, no, we'll not tax you yet. Let's give you CRA. I get it now. Let's give you CRA. Enjoy our CRA first. After CRA, let's give you some other things. If there was pension, all those things, let's take it out from you. But in this case, there's nothing like pension or any other thing in this question. So we're only going to be taking out what? CRA. So we are deducting our relief. It's a relief. So let's go CRA. You should still remember CRA, Abby. Let's see whether they did the work here. Okay, this is it. Yes. Exactly. Exactly. So let's do it. So should we just get the figure? Look at it. They've solved it here for us. So 200,000, Abby. The higher, Abby, of 200,000 or 1% of total income. So let's try one first. Help me do 1% of this 304,250. I'll do for the other one 1%. Which is this first one. I'll do for the second one 1%. So it's small. You see, so it's the highest one. What's the highest? 200,000. So when we did 1% of 3,041,250, you got 30 something thousand. Me too, I did 1% of 3,036,000. I got to 36,2075. Just cancel the first zero up at the back. So that is it. So we're going to be going with 200,000. That's why we have 200,000 all through in their own answer. So ignore the 1%. It doesn't make sense here. So plus what? 20% of the same figure. So they did 20% of what? 304,250 and 20% of what? 36,20750 and 20% of what? 4138. That is the law. Okay. So 200,000 plus 20% gave us this figure. So let's put it there. 808,250 924 150 and what? 1,027 600. Yes. Plus 20% of this plus 200. You get all those answers. Make sense? Okay. So no challenge. So take it out. You're going to take them out to reduce your business. So we're going to have our chargeable income. Chargeable income. Oh yeah, no. No, chargeable income. The income that we're going to, that is subject to tax. That's the income that we're going to tax now. We are supposed to tax our total income. But now that government is saying take CRA without you, is the remaining one that I will not tax. So if you minus it, all these things they are minus. That's deduct now. So you have 2, 2, 3, 3, 0, 0, 0. You have 2, 6, 9, 6,000. We have 3,110,400. It's supposed to be 600. I don't know why they put 400. Do this one for me first. Okay. 400, yes, 400. All right, that is that. So that is that. They want to just get our chargeable income, which we have done. So the next part is C. So I think they say we should get taxable, computation of tax. So tax payable. So that's our computation of tax payable. Which one? 600. So computation of tax payable by partners. So we'll just bring in our chargeable income, okay, for 3 of them. But that is the tax that is the place that I'm going to pay tax on. All right. Only very, very simple. So we have chargeable income. That's the income they're going to pay tax on. So we have 2,233,000. I mean, 2,696,000, and then 3,110,400. Just copy every chargeable income here and bring it down. Now let's tax. You know, I told you that we don't tax the partnership, we tax the partner using our normal tax table. So what's the tax table? Our tax liability table. The first 300, I mean, very simple stuff. So let's go first 300,000. At how many percent? 7%. You check at the back of your question paper, you see this table there. You know it now. So second 300,000 at 11%. Then the next what's 500,000 at how many percent? 15. The next what's 500 at how much? 19. Then any balance, have you? Okay. The figure is too small. And 1.6 is there now. We cannot go to balance. We want to do 1.6. To reach, don't worry. Let's see. I'm seeing it here. Yeah, let's try now. Okay, let's try. Okay. 7% of 300,000 is 21. To appear all through. No big deal. 11% of 300,000 is 33. Um, 50% of 500,000, 75. %19 of 500,000, 25, 95. You know the reason why we are just going without thinking about anything, I mean? No, because 1.6 million, we can fetch it out from these figures. That's why we are just going to, it's not like in all questions you bring out all these things. So depends on the weight of the chargeable income. This is 2.2, 2.6, 3.1. So you can bring out 300,000 from there. You can bring out another 300,000 from there. You can bring out 500,000. You can bring out another 500,000. So this is 1.6. Now 1.6 million. I get it now. Already taken out from 2.2. So take it out for me. 2233000 minus 1.6. Eh? Is that 633? You will now multiply by 21%. You understand? Or you help me multiply it. Look, this next 1.6. If that next 1.6 does not mean that the figure must be up to 1.6. It means any excess, but the excess should be in the bracket of 1.6 million. Balance. If you put balance at 21%, you are still correct. 132 9 920. Okay, 930. Let's do this one now. 1.6 minus 2696,000 minus 1.6. The difference times 21%. 230,160. I'm getting 230,280. Follow your own. Oh yeah, for the last one, 3,110,400 minus 1.6 million. Times 21%. I think this one should be good. Oh, it's 600. I don't want to give me. I mean, there should be 600. I mean, 600. 600. So let's just change this. Just ensure that when you are doing yours in exam, you are very careful. So we have 230,280. So we can now add up everything. Okay, we can add up everything. Don't add up this chargeable income, only this tax. Okay, 541. 184. 254. 286. Okay. Three 56. 930. Okay, so that is all. We are done. It's simple now. It's simple. It's fair. Okay, so I'll just leave the rest for you to just go and try your hands on it. This one that has basis period, you are going to use the basis period that we have done before. Commencement, cessation. This one has basis period. But the other ones, you should be able to try these ones on your own. Woland and Associates, same thing. Okay. This one has a life insurance premium that's tax exempt. Then CROA. So try this Woland. Let's see the question. Question 3. Question 3. Where is it? Okay, this is the term of Woland and Associates. Please try these 3 as assignments. Professor Wachuku and Dr. Orlando. So Woland. So try it. Compute accessible income and tax liability of the partners for the relevant tax. Yeah. Ladies and gentlemen, thank you for your time. Thank you for staying with me. I remain Dr. President.